Hello everyone, I'm Nova Lui, RHB Bank Head of Investor Advisory. Today I have Mr. Barnabas Gan, Acting Group Chief Economist of RHB Banking Group. Barnabas, thank you for making it for this podcast interview. We are at the very interesting moment and we wish to know how would this impact the future global economic growth and the equity market.
Thank you for having me today. I'm very happy to share my views.
Global growth has remained resilient throughout 2024. In your view, are we worried of the risks, especially when it comes to the impact to China and ASEAN?
I think essentially short-term global economic volatility will likely be insufficient to dent the remarkably resilient global economic growth trend. Overall, the potential protectionist-led policies and the negative impact that it may have on China and ASEAN will still be on the forefront of investor concern, but we think it's still too early to call for a sizable downturn henceforth. In fact, we actually upgraded ASEAN's GDP growth outlook throughout the course of this year, especially for Malaysia to 5% from 4.7, Singapore to 3% from 2.5, Thailand's growth to 2.6 from 2.4, as well as maintaining a view for Indonesia's growth momentum to accelerate to 5.2% in next year. Separately, we are also keeping China's growth outlook at 5% and 4.8 for this year and next year, respectively. And this is really given the recent stimulus measures and rate cuts amid continued fund inflows into the Middle Kingdom.
Make US great again. Do you see the policy will impact US economic growth in 2025? And do you think the current global geopolitical tension in Middle East and Russian-Ukraine war may potentially de-escalate?
We think that is inherently supportive of US growth prognosis into 2025. Beyond the tariff-related policies, these policies had been called to support US businesses and consumerism. If I could cite some examples, the extension of the 2017 Tax Cuts and Job Acts, reduction of state and local taxes, lowering of corporate tax rates, and also exempting various types of income from personal tax. The approach to make America great again. It's likely supportive of US economic growth, and this will inject upside bias to our US growth expectations of 2% for next year. Do note that back in 2017 to 2021, America First policy has also led to a strong economic showing during the said period, and this is a remarkable feat despite COVID-19 back in 2020 to 2021. Beyond the US-centric economic benefits, the new leaders rhetorically staunch opposition to geopolitical conflict escalations. We have actually seen that he has mentioned he wants all of the Middle East conflict to stop, and for Middle East to get back to peace. And on the issue of the Russian-Ukraine war, he has cited his intention to broker, a negotiated end to the conflict. Yeah, so I think the issue, of further de-escalation of geopolitical tensions will also be beneficial for risk-taking behavior across the globe.
Thanks, Barnabas, for the comments. In your opinion, should we continue to stay bullish on US-centric equities given the relatively high US equity market valuation?
We are maintaining our trade idea to actually long develop market equities, especially US-centric ones, and this is cited in our previous thematic report. Further risk-taking behavior amid sustained net inflows into US-centric assets in 2025 will likely mean a further 10 to 15% rally in S&P equity valuations. We are also cautioned against trading on higher fear index or the VIX volatility, and this could likely happen in the next 2 months. But however, we do see that the higher VIX levels are empirically seen in the past, but this is likely due to short-term uncertainties over policy clarity amid the change of administration, and this is likely a temporal phenomenon.
Do you think the sweeping tariff may elevate supply chain congestion and lift input prices worldwide?
Clearly, there will be other factors at play. We are seeing that tariffs can raise supply chain congestions and raise higher commodity prices, and this is a cause for concern. But another avenue for higher growth prognosis and supported risk-taking behavior could stem from actually lower energy prices. In fact, we have seen intention to increase US oil production via more fracking activities to increase shale oil production, and this is really with the goal to reduce US energy costs by half. But the thing is that US prices, especially the break-even cost of production for shale oil, typically falls within $50 to $60 a barrel. And this basically indicates that the downside to oil prices might be capped by the relatively higher production costs from the shale oil wells. But nonetheless, we still see for a risk for Brent prices to decline to about $70 a barrel into 2025. And this is really assuming there's a push for higher oil production that could actually negate the upside risk from higher global demand conditions as well.
Last but not least, is there anything keeping you awake at night with the new leader being appointed?
Is the I mean, this is interesting. I mean, in the sense that, well, it's true that most of my rhetoric is largely positive, but there will likely be caveats. I think we see three key risks. The first area of contention may stem from the revisitation of the US debt ceiling risk, especially when the suspension of the debt ceiling in the Fiscal Responsibility Act will expire by the 2nd of January next year. We note that the higher rise in the national debt was really seen back then, whereby it actually rose by almost 7.8 trillion, and the pace of rise in the public debt is so huge that I think probably we may need to revisit this risk again when the expiry of the debt ceiling comes into play. And with that, I think probably investor sentiments might take a downtick, especially when the debt ceiling issues comes, and be reintroduced again into the latter part of next year. Secondly, I think the verdict on inflation is still up for debate, but we still see a chance for higher inflation concerns. I think if we assume all things unchanged, the tariff imposition on US imports will mean that US core inflation will rise sharply to 4%. On the back of the higher tariff. And this basically indicates that there still be upside bias overall US inflation, especially in the short to medium term. Of course, people might speak about potential counter aspects from higher oil production, which may actually drag and push oil prices down, or for that matter, corporate tax cut that could actually reduce production costs for firms. But we recognize that there could be potential structural lag effects from these policies, which basically means that at least in the short term, inflation risk should still be much paid attention to, especially into the first half of next year. Last but not least, we also cannot discount the negative implications to global trade and investment. We are most cautious on Singapore and Malaysia, given their reliance on trade and investment, particularly from China. But consumption-based economies such as Indonesia and Thailand may see adequate buffers against external volatilities. I think overall, the direct impact to ASEAN may be contained because the imposition of the import tariff at this juncture is understood to be implemented across all imports at the very small rate of 10%, but we are very cognizant of second-order negative impact on trade and investment activities, especially China's investment and trade exposures to ASEAN.
Thanks again, Barnabas, for joining us today. We hope that this latest podcast series may provide insightful information to help our investor making better informed investment decisions. Dear investor, please engage our relationship manager to review your investment portfolio. See you again in our next podcast series.